Peace and honor, everybody. Y'all know me, I'm Kadira.
And I'm Kimberly.
Peace, Kim, and I'm so grateful that you're joining me.
My pleasure.
We also have
Little one down here, Deuce, just to let you guys know, he will be down here. Try our best not to show him on camera, but he is down here. Okay. Little man, 8 months.
Okay. So what we're going to do is we're going to read the Basic Trading Manual. It's by Timothy and Deborah Lewis. It deals with 40 Traders Institute. Very valuable information. Okay, so we're going to skip the disclaimer.
Yeah.
And get on into the bits and pieces of things. I do like the introduction so that you can be introduced to this properly. You want to start?
Why not?
Okay.
Okay, everyone. Welcome to the world of futures training. We have developed this informative manual as a guide for you as you start out on your trading business and to provide information on how you can profit from the markets. We have provided the information in the order that would be best for you to learn, and therefore we suggest that you complete the sections in the order that they are provided. For those familiar with trading, you may be able to skip the first few modules, which contain general basic information about markets and trading. However, a review can always be helpful. Always, if you have some trading experience, please keep an open mind when reviewing the material so that you can get the most out of the manual.
Trading Essentials. Section 1, Traits and Survival Skills. The traits of a successful trader includes patience, discipline. Each trader must determine the rules that he or she will trade by and then be disciplined enough to follow those rules. This includes being patient and waiting for the right setups to get into the market. Often new traders are so anxious to trade and be in the market that they overtrade and they do not wait for the higher percentage setups. Trading is about taking trades that have the best percentage of going your way. Each trader will have losing trades, but if you remember to minimize your losses, don't let trades go too far against you. You will be a successful trader. If you have 10 trades and are right about 50% of the time, you will still be profitable. If your winning trades are larger than your losing trades. Each trader must also guard against the two villains in trading, which is fear and greed. When your trade is going your way, it's easy to become greedy and stay in longer than you should. Also, when trades are going against you, new traders have a tendency to let fear of loss keep them from an existing losing trade. We'll talk about this more when we discuss money and trade management.
Section 2, Steps of a Successful Trader. There are several steps that a trader should follow in order to be a successful trader. You must have a good, reliable computer and an internet connection, high speed. It is recommended that if you have wireless internet to be hardwired to your router to improve data integrity. We recommend that each new trader should start out paper trading. Paper trading is a way of trading in simulation mode so that you are not risking any real money. It is very important to start out paper trading so that new traders can become familiar with the way the market flows, how to get in and how to get in and out of trades and how to manage their trades. It is best to paper trade until you have a strategy that you have confidence in and are constantly getting profits from. We will get into more detail about order entry and trade management later in the manual. Suffice is to say, these are very important items. When paper trading, it is very important to trade as though it is real money and not to be careless with your trades because you are only simulating. Often when traders switch to trading real money, the emotion of losing real money will cause new traders to stay in a trade longer than they should and lose more money than they would if they followed their trading rules. Please be careful. Each trader will have to open a trading account and select a broker. There are many brokers and clearing firms available. We will be happy to give information on the firms that we use, but it is each individual's decision on who they open their trading account with. A trading platform must be set up. We use Ninja trading platform and all are trading and in the live trade room. You will need a live streaming data feed so you can receive the market data in real time.
Some people use MT4, which is also known as MetaTrader 4 or MetaTrader 5. Section 3, establish a business plan. Trading is a business, and as such, each trader should set up their own business plan. The following are some items that you may want to consider in your business plan. Number 1, write out your business plan. Then number 2, keep a journal of all your business issues. 3, detail how you will raise the money to fund your business. You will need such as items as computers, trading accounts, office furniture, etc., and to pay for any ongoing expenses such as data feeds, commissions, or where you will get funds from if they are not readily available. Number 4, write down your daily and your monthly trading goals. 5, set your daily profit goals, the goals you wish to reach in each profit in each day. Also, be sure to set your risk, your loss per trade, and maximums that you're willing to lose per day. Keep a written record of all your trades per day so you can assess your trades. This is number 6, and this will help you learn from your mistakes. Number 7, make sure you know how to contact your broker, order desk, in case you have technical problems, such as your computer being freezed up or your dropped internet service, and you need help getting out of a trade.
Section 4, basic trading guidelines. Each trader should have guidelines that he follows when he trades. So whether you are trading part-time or full-time, you will need to be disciplined and follow your trading rules. Even though you will create some of your own, following are some great rules to start with. Number 1, trading is a business and should be treated as a business and not a hobby. You must limit all distractions while trading, such as watching TV, talking on the phone, playing with your kids, and etc. Number 2, determine your risk and reward before you enter a trade. Before you enter a trade, you should know where you will exit the trade if it does not go in your desired direction. This is very important. You must be disciplined enough to follow your plan, even if you have to exit the trade with a loss. Number 3, never trade with scared money. You should never risk any money in the market that you are not able to lose. An example, don't trade with your rent or food money. Number 4, be disciplined in taking small losses and letting your profits ride. Number 5, don't be a one-way trader. Be comfortable buying and selling. Number 6, never add to a losing trade. This increases your risk. It is possible to scale into a winning trade, but never scale in the reverse. Number 7, once you have a profit in the market, never let it turn into a loss. Number 8, do not chase the market. If you miss your entry, don't force a trade. Number 9, never move your real or mental stop loss order. This will only lead to you losing more money. Usually your first loss is less than if you try to rationalize why you should stay in a trade. Number 10, there are many economic new events that happen daily that can greatly affect the market. Do not trade during these new announcements because the market can be extremely volatile during these periods.
Section 5, money management and trade sizing. As mentioned many times before, it is very important to have money management plan in place. Money management involves knowing how many contracts that you should be trading, how much money you should risk on any trade, and how to know when to stop trading. Each broker has an established margin amount required for trading one contract in each given market. For the E-minuses, this is usually around $400 to $500 per contract, or as much as $1,500 per contract, depending on the broker. You should not be over leveraged in the market, and therefore you should have more money in your account than required for these contracts in order to allow for fluctuations and possible intradips. Therefore, although not required, it is suggested that you have at least $1,500 in your trading account per contract to be trading. As your trading account grows, you'll be able to trade with more contracts per trade and thus increase your earnings this way. Another aspect of money management is not to risk all of your account on one trade. Therefore, if you have a surplus of $500 in your account, you should not let one trade go $500 against you. Again, we want to cut our losses small and let our runners run. Many traders will have a daily profit goal that they shoot for. While this is not bad, be careful that this does not entice you to take unwise trades just because you're trying to make a certain amount per day. On the other hand, if you do have a goal, it is very wise to stop trading and paper trade or demo trade once you have reached your goal or even quit trading for the day. There is nothing quite as frustrating as having made your goal in the morning and then losing all of your profits by the end of the day.
Section 6. What are the E-mini futures and why are they so powerful? We all have heard about the stock market, the forex market, and some even have heard about the futures market. Futures are contracts that are bought and sold based on whether an individual thinks the underlying market is going up or down in the future. The future market does not actually trade the underlying markets or indices such as the S&P 500, Russell 2000, NASDAQ, and Dow, but rather the future directions of the underlying markets. Well, you may ask, why do we focus on the futures markets? The answer is simple. Number one, stocks are not as volatile as the futures markets are, meaning that there are larger swings in the prices of the futures, giving us more opportunity to make money. The futures markets are also much more liquid, meaning that there are always many orders buying and selling at the same time. Sometimes you can buy stock, and because it has low volume, you will have to wait in order to sell because there has to be someone who wants to buy in order for you to sell. The market is referred to as a zero sum because when someone wins, someone else loses. Number two, when dealing with the stock market, you have to have a well-funded account in order to purchase most stocks and be able to profit enough on each share to make a sustainable profit. For example, if you buy 100 shares of stock ABC at 20 each, you will have to pay out a total of $2,000 plus commission. If the shares increase in value to $21 and you sell them, you have made $100 minus commission. There's no comparison to trading futures. For futures, each instrument has a predetermined margin amount set by your broker that you must have in your account to trade one contract. This amount is usually around 400 to 500 for markets that we trade. And with futures, we are just trying to get points. For example, the S&P E-mini pays 50 every point you make. For example, if we purchase one S&P futures contract at 1,800 and it goes up 2.5 points, we have just made 125 and we did not have to actually pay for the contract, but must have the 400 minus 500 in our account to allow the purchase. Then as future traders become more skilled and disciplined, and if their accounts have grown significantly, they will be able to buy and sell more contracts per trade and thereby increase their profits. Number three, when day trading in the stock market, you have to have $25,000 in your trading account. However, this is not a requirement for trading the futures market. So as you see, it is much more favorable to trade the futures market than the stock market for the above reasons.
Trading basics and technological analysis. Section 1, basics about popular E-mini futures. There are only a few futures that we like to concentrate on. They are usually very volatile and very liquid and provide many optimal trading opportunities daily. Now, looking at chart 1 for the basic information about these markets. Chart 1, basic information for popular future markets. E-minis, S&P. The symbol is ES. 1 point value is $50 and ticks per point is 4. So then the tick value, according to this, is $12.50. E-mini Russells. The symbol is TF. 1 point value is $100 and the ticks per point is 10. Now the ticks value here is $10. The E-mini of the NASDAQ is NQ. 1 point value is $20. The ticks per point is 4 and the tick value here is 5.
Section 2, types of orders and placing orders. There are several types of order that can be placed when you are trying to get a position in the market. The main types of orders are as follows.
You see?
Limit order. When you place this type of order, you are filled at the price you selected or better, but you will not get filled if that price is never reached. Number 2, market order. When you place this type of order, you are filled at whatever the current ask price is when your order is placed. Therefore, you have experienced what is called slippage with a market order because by the time your order is filled, the asking price may have moved a couple of ticks from where it was when you placed your order. Number 3, stop and stop loss order. This is the type of order you can place if you are already in the market and you wish to exit if the market moves in your favor to a certain level, stop order, or if it moves against you by a certain amount. For example, let's say we bought one contract of SP E-mini at 1,650 and we are looking for a 2-point profit. Then we would place a sell stop at 1652. And when that level is reached, our contract will be sold and we will be up $100, $50 per point for the S&P. Conversely, if we don't want to risk more than $100, we can place a stop order at 1,648. And if the market goes down to that value, our contract will be sold and we will be down $100. We will discuss trade management and money management in more detail later. Both are very important when trading in the future market.
Section 3, chart styles. When we look at the stock market to see what is happening with the various markets, there are several methods of charting to show how the market is moving. Each chart is made up of bars that show the price action of the stock or futures during a certain period of time. For example, a chart that has a new candle every 3 minutes is referred to as a 3-minute chart. Different traders use different time values for their charts, anywhere from 1 minute to 1 hour to 1 day per candle. We primarily use 3-minute charts in our trading, since we plan to be in and out of the market quickly. Those who swing trade, meaning they stay in the trade for several days, sometimes usually use a daily candle chart. This means that each candle represents the price action for a whole day. There are also several different ways that the candles on the charts can be represented. One method is called a bar chart. You'll see that in figure 1. This is a 3-minute bar chart. In the bar charts, each candle is represented by a straight vertical line with a short line extended to the left of the candle that represents where the candles opened. It also has a small line extended to the right of the vertical line that represents where the candle closed. The lower end of the vertical bar shows the low of the candle, and the upper end of the bar shows the high of the candle, as you can see in figure 2. For example, a bar chart candle. The bars are all black unless you change the colors, so no market direction is easily seen. The second chart type is a candlestick figure. 3-minute candlestick charts on figure 3. This chart is made up of candlesticks and is a type of chart that we use daily in our live trade room and educational materials. Again, each candlestick represents the price action for a certain period of time. For example, 3-minute charts where each candle represents 3 minutes of price action. The candlesticks give the same information as the bar, but it's clearer in most people's opinion. Each candle is made up of a body and an upper and lower bar. The bars that extend above and below the body of the candle are called the wicks. See figures 4 through 5 for examples of candlesticks. The color of the candles tell us whether the candle is bullish. Bullish is called closed higher, that is open, or bearish is closed lower, that is open. Bullish candles are generally clear or green, unless you change the colors, to represent a market that is moving up. And in this case, is green. Bearish candles are generally dark or red in this example to represent a market that is moving down. In figure 4, it's an example of the bullish candle, closes at the high to the low. And for 5, it's the down candlestick. Section 4.
Section 4, market movements. The market can move in 3 directions: up, down, sideways. The market flows up and down in trends. A pretty popular phrase in the trading world is, "The trend is your friend," and we will focus on trading in the direction of the trend. See figure 5 for an example of an uptrend day. As you can see, the prices are going up. As such, we should be buying. See figure 6 for an example of downtrend day. As you see, the prices are going down, and as such, we should be selling. The market can also go sideways or be range bound, meaning that it is fluctuating up and down within a small price range. See figure 7 for an example of range bound or sideways market. We will discuss in more detail how to determine the general direction of the market. Figure 5, chart of an uptrend. An uptrend is defined as a market making higher highs and higher lows. A downtrend is defined as a market making lower trend, making lower highs and lower lows. Figure 6 is an example of a downtrend. Figure 7 is an example of a chart showing sideways marketing movement.
Trading success principles. Section 1, analyzing market directions. There are 2 forces at work when the market flows. They are support and resistance. These are key price levels at which the market previously met with resistance or support. The resistance is the ceiling, and the support is the floor. An easy way to think about this is to consider what would happen if you stood on a chair and threw a ball down to the floor. When it hits the floor or the support, it would bounce up. If you threw it with enough force, it would bounce off the floor and hit the ceiling or the resistance and then bounce back down. This is how the future markets work. When the market sells down to a point where there's support, where sellers are no longer willing to go any lower, the price will bounce and move up higher. Likewise, when the price goes up and reaches resistance, a point so high that buyers are not willing to pay more, the price will bounce and move lower. We refer to this as pullback. These levels of support and resistance can be good areas to get into the market, as we will discuss later. Also, many times when a resistance level is broken, the same level can then become a support. Likewise, when a support level is broken, that same level can become a resistance. Determining the primary direction of the market is very key, and whether we want to buy, going along, or selling, going short the market. If the market is making higher highs and higher lows, as we saw in figure 5, then we can say that the market is trending higher. If the market is making lower highs and lower lows, as shown in figure 6, then we can say that the market is trending lower. As you can see on the charts, when the market is moving in given direction, it does not typically go up, straight up. Every so often in an uptrend market, the market has to breathe or pull back. This is because buyers are exiting their positions. They're selling in order to take profits. But once a level of support is reached, the buyers step back in and the market begins to move higher again. Likewise, ever so often in a downtrend, the market has to breathe or pull back. This is often because the market is oversold and sellers are buying in order to exit their position. However, once the market reaches a level of resistance, it begins to move lower again. Therefore, if the market is in an uptrend, our goal is to buy in the direction of the trend. Once the market makes a new high and then pulls back to a reasonable level of support, see figure 8 for an example of this uptrend with pullback highlights. Here's figure 8, uptrend with pullback highlighted. Likewise, if the market is in a downtrend, our goal is to sell in the direction of that trend. Once the market makes a new low and then pulls back to the reasonable level of resistance, which you'll see in figure 9, for an example of the downtrend with pullbacks highlighted. When the market is trending down, making lower lows and lower highs, and then it pulls back and goes above the most recent swing highs, this then is a good indication that the market has changed directions and that you would then be looking to buy or go long after a new high and pull back to a reasonable level of support. The opposite is true if the market is trending up, making higher highs and higher lows, and the market pulls down below the most recent swing low. This is a good indication that the market is changing directions and that we will be looking to sell once a new low is created and then the market pulls back to a reasonable level of resistance.
Section 2, Fibonacci retracements. I'm glad I was able to read that word.
She went to college.
Back in the 13th century, a mathematician named Leonardo Fibonacci discovered the Fibonacci series of numbers. The Fibonacci retracements used in trading are derived from that famous series of numbers. The basic theory is using Fibonacci retracements is that when the markets move in a given direction and then starts to pull back, that by using these ratios, you can estimate when the market or when the pullback will run into some resistance or support. The percentages that we use most are 38.2%, 50%, and the 61.8% retracements. In order to use the Fibonacci retracements, you define a swing in the movement and connection and connect the two most distant points, the low of the swing and the high of the swing, and use the percentages to define areas of potential resistance or support. Most charting software has a tool that will give you the Fibonacci retracement levels if you use your cursor to draw a line between the high and low of the swing. See figure 10 for an example of how the Fibonacci retracements work. Generally, if the pullback goes past the 61.8% retracement, it is a good chance that the trend has been broken. For example, if the market is trending up and then pulls back past the 61.8% retracement, chances are that the market may have turned into a downtrend. Likewise, if the market is trending down and then there's a pullback past 61.8% of the day's movement down, then there is a good chance the market has reversed and is now going up. Figure 10 is an example of the Fibonacci retracement. In figure 10, you can see that the market is in a downward trend, and when it pulls up, it comes right to the 38.2% retracement level, hits resistance and turns and continues downward.
Section 3, key moving advantages and levels. Just as the Fibonacci retracement helps us to determine possible levels of support and resistance, we have our indicators and our averages that can give additional assistance in these areas. A moving average, or an MA, is an average price of a stock over a specific period of time. Thus, the 8 SMA is calculated by adding the closing price of the last 8 candles and dividing the average by 8. Moving averages can be added on charts very easily as a part of the platform software. There are many moving averages, but the ones we concentrate most on are the 8 EMA, the 20 SMA, and the 50 SMA, as well as the 200 SMA. The SMA, or the simple moving average, is determined by averaging the most recent N number of closing prices. The EMA, or the exponential moving average, is the average of the last unknown number of closing prices, but is weighed more towards the most recent candles. When these moving averages are added to your trading charts, they can give good clues as to the direction of the market. They are generally color-coded on the chart so that they can be easily distinguished. Our method of charting them on the NinjaTrader is as follows. 8 exponential moving average is yellow. 20 simple moving average is red. 50 simple moving average is blue, and the 200 simple moving average is green. Now, on most trading platforms, you can change these colors. The 50 moving average is the blue line and figure 11, and the 200 moving average is the green line. These two are the most powerful moving averages. Many institutional managers, hedge fund managers, and the media watch these moving averages to gauge the market. Hint, hint. If you see figure 11, for example, it'll show you the moving averages on these charts. Figure 11, candlesticks charts with moving averages. Now, other areas of support and resistance are the open, the high, the low, and the closing of the previous day. This is referred to as the OHLC and can only be seen easily on these charts. Often, the previous day high, low, and close will serve as a great resistance or support. See figure 12 for an example of how the previous day's lows can serve as a resistance. As seen in figure 12, once the price went down below the previous day's lows and pulled back up to it, the previous lows now serve as the resistance, and a powerful candle pattern was then created. See figure 13 below for a candlestick chart with candle pattern highlighted.
Section 4, Powerful Candle Patterns. Charts are used to analyze various types of patterns, formations, and market data. Once you learn how to recognize the patterns, you can use them to help time the entries and exits for your trades. As with other items in trading, no pattern is perfect. Some will fail. You should never make a trade based on just one pattern or indicator, but rather use them with other areas of support and resistance, such as moving averages, Fibonacci retracement levels, OHLC levels, and etc. Following are some single candlestick patterns that may give you some indications of the current price actions. You believe that says doji?
I would say doji.
Okay, doji. Doji are made up mostly of shadows or wicks above and below the real body, which appears thin and flat. This means that the price shot up and down during the candle, but opened and closed in the tight range. This indicates that the bull and bears are having a tug of war. Long upper shadows are bearish indicators, and long lower shadows are bullish indicators. You can use these as powerful indicators to determine when to enter and exit trades. If you are long and see a very long upper shadow, even if the candle is green, you may want to consider exiting your trade or tightening your stop loss order. If you are long and see a very long shadow and are deciding whether to get out, you might want to wait a little longer. Hammer. A hammer has a small stub as the upper shadow and a long lower shadow. Its short, real body is at or near the top of the candle. The hammer is a very powerful indicator of strong support and often signals the end of the downtrend. If in a downtrend, it is a low risk, high percentage buy trade, especially if it occurs at a level of support. You can buy when the high of the hammer is broken and place a stop loss order below the bottom of the candle. Hanging man. A hanging man looks like a hammer, except it happens in a strong uptrend and often signals the end of the trend. In this scenario, you could go short or sell if price goes below the low of the hanging man and place a stop loss order a little above the high of the candle. This will help to limit your risk. Use caution with this one because the long lower shadow is still considered bullish. Next are some 2 candle patterns that can give some indication that a change in direction may occur. Inside bar. Bullish inside vertical bar. This is a 2 candle pattern in which the first candle is a red candle followed by a smaller candle that has a higher low and a lower high than the preceding red candle. It is therefore engulfed within the previous candle. This is a very bullish indicator. When this pattern occurs during a downtrend, it may signal a change in direction. You can buy when the high of the inside candle is broken. Place a stop loss order slightly below the bottom of the tall red candle. Bearish inside vertical bar. This is a 2 candle pattern in which the first candle is a green candle followed by a smaller candle that has a lower high and a higher low than the preceding green candle. It is therefore engulfed within the previous candle. This is a very bearish indicator. When this pattern occurs during an uptrend, it may signal a change in direction. You can sell when the low of the inside candle is broken. Place a stop loss order slightly above the top of the green tall candle. Outside bar, bullish outside bar. This is a 2 candle pattern in which the first candle is a red candle followed by a taller green candle that has a lower low and a higher high than the preceding red candle and closes within the top half of the green candle. It therefore engulfs the red candle before it. This is a very bullish indicator. You can go long, which is buy, with a stop loss order slightly below the midpoint of the tall green candle. If the green candle is not very tall, you can put the stop loss order slightly below the low of the green candle. Bearish outside vertical candle or vertical bar. This is a 2 candle pattern in which the first candle is a green candle followed by a taller red candle that has a higher high and a lower low than the preceding green candle before it. It therefore engulfs the green candle. This is a very bearish indicator. You can go short with a stop loss or slightly above the midpoint of the tall red candle. If the red candle is not very tall, you can put the stop loss order slightly above the high of the red candle. Dark cloud cover. A dark cloud cover is a bearish reversal pattern that may signal the end of an uptrend. The first candle is a strong green candle followed by a second red candle. The red candle opens above the high of the green candle and closes below its midpoint. The lower the red candle closes before the midpoint, the more bearish the signal. The piercing pattern. The piercing pattern is a bullish reversal pattern that may signal the end of a downtrend. The first candle is strong red candle followed by a second green candle. The green candle opens below the low of the red candle and closes above its midpoint. The higher the green candle closes above the midpoint, the more bullish the signal. And figure 13 is an example of a candlestick chart with candle patterns highlighted.
Section 5, powerful chart patterns. You have double tops. As shown in the figure, a swing high is created followed by a swing low. This is higher than the previous swing low. Then there's a push up to retest the prior high. If the resistance of the prior high holds, then there is still a potential for a double top. Once the valley low is broken, a double top is confirmed. After the breakdown of the valley low, you can trade this pattern by selling. Short right after the breakdown of the valley low. You can also sell right after the second swing of the high of the pattern. You remember what selling is? Selling is bullish. You will place a stop loss order above the double top resistance in case the price moves higher instead of lower. Now, if you have a double top, you know you got a double bottom. The double bottom, as shown in this figure, is a swing low. It is created followed by a swing high that is lower than the previous swing high. Then there's a push down to retest the prior low. If the support or the prior low holds, then there's still a potential for a double bottom. Once another pullback goes above the swing high, a double bottom is confirmed. You could trade this pattern by going long where you buy right after the breakout above the swing high. You can also buy right after the second swing low of the pattern. You will place a stop loss or order below the double bottom support in case the price moves lower instead of higher.
Section 6, volume analysis. Another item that must be considered when examining the market is volume. Volume, the amount of contracts being traded during each candle's duration, is very important in determining if there is good crowd participation in the move. For example, if the price is breaking out above a resistant level or breaking down below a support area, you want it to be accomplished by high volume, showing that a lot of traders are involved in the move. Breakouts on low volume usually do not make it. Also, if a trend has become or has been going for a long time, we call this extended. It often will end with a climax or long candle with high volume. So look for this also as a potential time to lock in profits or tighten your stop loss order in case the market turns directions. Likewise, if the market is trending and you start seeing high volume of candles in the opposite direction, this could be signaling a change in direction.
Money-making strategies. Section 1, starting the trading day. Each trading day is an adventure, and every trader must be ready to face it. We recommend that you get a good night's rest and something good to eat for energy before you even start trading. For those who are trading the opening of a market, you need to start at least 30 minutes before the market opens at 9:30 Eastern Standard Time, so that you can look at some key information before the markets open. You need to look at and be aware of the following items before the market opens: where the market is opening in relation to the previous day's highs, lows, and close. And number 2, the overnight highs and lows are the most recent swings, the swing high, the swing low, before the market even opens. Often these levels can be a great resistance or support if they are tested in the first 30 minutes of the trading session. Please be aware that the first 3 minutes to 5 minutes of the trading session can be very volatile and can have big swings in opposing directions. Often, it is safer to wait for the first 30 minutes to pass to get a true direction of the market. Many traders refer to this as the 10 a.m. rule. The only time this may apply is if the market has a gap up or down in the morning. See more about what gaps are and how to trade them below. There are several key trades that can be made in the morning, one of which is the gap trade and the other is the 10 a.m. breakout trade. We'll discuss these also in the next section. You should be very cautious when trading during the first 30 minutes of the trading session because it can be very volatile and often the market will not show its true direction until after 10 a.m. Therefore, during this volatile period, any trades that are taken should be scalp trades, where the goal is to get a small profit on the trade and get out quickly.
Section 2, first trades of the day. One of our favorite trades is referred to as baiting the gap. To understand this trade, we must first understand what a gap is and how we need to react to it. The opening gap is when the market opens significantly above or below where the market closed the previous day. A gap open is when the market opens much higher than it closed the previous day. A gap down is when the market opens much lower than it closed the previous day. The gap can be created by overnight trading or pre-market news that causes the difference between the previous day's close and where the market is opening. Often, trading overnight can be very volatile and can build movement in the market that cannot be sustained. As such, when the market opens, we often see that the prices will move to go back to the level where it closed the previous day. Therefore, if the market gaps up, we would expect the market to go down in order to get back down to the previous day's close. And so depending on price action, we will be going short or selling. If the market goes down, we would expect the market to go up to get back up to the previous day's close. And depending on price action, we will be going long or buying. There are several ways to enter a trade by filling the gap. There are several ways to enter a trade for filling the gap. Number 1, wait until there is a breakout above or below the first 3-minute candles in the direction of the previous close. Number 2, wait until you see an inside bar, which may be signaling that the movement away from the previous close may be weakening. Number 3, wait until you see a reversal bar or pattern such as a hammer if going down, doji, hanging man if going up, etc. Of course, once you enter the trade to fill the gap, you should follow all your management and stop loss rules and limit your risk to predetermined amount. Always know your exit before you enter a trade. If you're not in the market on a fill the gap trigger, the second trigger for an early market trade is called the 10 a.m. rule. Basically, the 10 a.m. rule allows the market 30 minutes to oscillate and find its direction. The 10 a.m. rule is simple. You find the highest price market the first 30 minutes and the lowest price during the first 30 minutes and use these levels as your triggers. After 10 a.m., if the market breaks out above the 10 a.m. high, then this would trigger going long, which is a buy. After 10 a.m., if the market breaks out below the 10 a.m. low, then this would trigger going short, which is a sell. As always, you must maintain your money management and stop loss rules. The 10 a.m. rule will also help you evaluate your gap fill trade. If the market gapped down and you are long because of one of the situations listed above, if the market retraces and goes below the 10 a.m. low, you should exit your long trade and consider going short. If, however, the market gapped up and a short was triggered by one of the situations above, if the market retraces and goes above the 10 a.m. high, you should exit your short trade and consider going long. When either of these scenarios happens, it is referred to as the gap and go. When taking the 10 a.m. breakout trade, we can be conscious of any major resistance or support that may be in the area. Also, as a good rule of thumb, if the 10 a.m. breakout triggered a buy, You should get out of the trade if the market moves back lower than the low of the candle that you entered the trade on. Likewise, if you are short because the market went below the 10 a.m. low, you should get out of the market if the market moves back higher than the high of the candles that you entered the trade on.
Section 3, additional trend trades. As stated before,
Oh, as long as his face is on.
okay. As stated below, we want to be trading in the direction of the trend. Whichever direction is indicated by the breach of the 10 a.m. high or low, we will trade in that direction until we see an indication the trend has changed. Several things might indicate a change of direction, such as a pullback past the 61.8% Fibonacci level, or if it is an up day, the creation of a new low below the most recent swing low. And if it is a down day, of the creation of a new high above the most recent swing high. If the trend is up due to the breakout above the 10 a.m. high, we will be looking for a pullback to some reasonable level of support to go long, which remember is a buy. If the trend is down due to the breakdown below the 10 a.m. low, we will be looking for a retracement up to some reasonable level of resistance to go short. Before entering the trade, determine where your stop loss order should be placed to limit your risks if the trade does not go in your direction. In an uptrend, a good profit objective is to exit the trade once the price goes back up at least half of the distance for where you got in the most recent swing high. If you have more than one contract, a second profit objective would be to hold your additional contracts until the price tests the most recent swing high, which is a few ticks below. It is safer. If you are trading 3 or more contracts, you can leave one contract as a runner to see if the price action continues in your direction. Likewise, in a downtrend, a good profit objective is to exit the trade once the price goes back down at least half of the way from where you are sold to the most recent swing low. If you have more than one contract, a second profit objective will be to cover or buy when the market goes to the test. The most recent swing low, a few ticks above, is safer. If you are trading 3 or more contracts, you can leave one contract as a runner to see if the price action continues in the direction. In both situations, make sure to keep your trading stop in mind so that your runner does not cause you to lose any money that you have banked. In other words, do not let the runner go past where you got in on the trade. Therefore, as long as the market continues to move in the breakout direction, you should be looking to enter the market on a pullback. In an uptrend, you should wait until a new high is created, and when the market pulls back to a reasonable level of support, such as moving average, previous day high, low, or close, or the most recent swing high level, then you can go long. In a downtrend, you should wait until you see a new low is created, and then the market pulls back to a reasonable level of resistance, such as moving average, previous day low, high, or close, or the most recent swing low level. Then you can go short or sell.
Section 4, powerful candle pattern trades. We learned several powerful candle patterns earlier in the course. Now it's time to combine these with other items that we have learned. When watching the market, you must be on the lookout for the powerful candle patterns. They occur quite often during the day. However, each occurrence will not trigger a trade. The patterns are most powerful when they occur in conjunction with another indicator, such as if they occur at or near the previous day's high, low, or close, or if they occur when the market is at or near a moving average. Also, if they occur near one of the Fibonacci retracements that we target, 38.2%, 50%, or 61.8%. If the pattern occurs at one of these levels of resistance or support and you take the trade, remember to take your stop loss order or dictate by the pattern. Do not be tempted to move your stop loss order because if the level where it is located is violated, you probably do not want to be in the trade anymore.
Section 5, trade management. Now, let's talk some more about the trade management. New traders should start out trading just one contract. This will make trade management easier because you know how much you are willing to lose per trade and you know your profit objectives as discussed earlier. Also, if you are in a trade because of a candle pattern, you will have an even more defined stop loss based on the pattern. If, however, you are trading multiple contracts, you should keep the following items in mind. Depending on the number of contracts that you're trading, you should close a majority of them once the first profit objective is hit. Then you know that you are making money. You can also adjust your stop loss order by moving it to the break, even to where you got into the trade on the remaining contracts. Therefore, no matter what the rest of the trade does, you know that you have banked money in your account. If you are trading 2 contracts, then your second objective for profit would be a few ticks before the most recent swing high or low, depending on whether you buying or selling. If the price ranges and reaches this level, then you will cover your remaining contract here. If you are trading 3 or more contracts, then you can cover all but one few ticks before the most recent high or low, depending on your direction, and let the final contract go as a runner. Be conscious of the fact that even though you want the final one to be a runner, you do not want to let it come all the way back to the entry point, if at all possible.
All right, guys, we're at the conclusion. Concluding, trading is a business, and each new trader must determine if this business is suited for them. Simple. You must be disciplined and dedicated to make this business work. Trading is based on making intelligent decisions to get into trades and then managing your decisions. It is important not to overtrade, but to focus on only taking high probability trades. We hope this manual has been informative, and we will assist you as you begin your trading business.
Awesome. Thank you so much, Thomas. Thank you so much, Goddess, for helping us read along. And we're just so grateful for you. We look forward to being profitable together. Peace.
Peace.